If you have a significant amount of money in your traditional retirement accounts, IRAs and 401ks, one of the things that you're probably starting to think about as you go into retirement, and especially in the early part of your retirement, is what those taxes are going to look like as you start to distribute that money from your retirement accounts to cover your living expenses. And you might be thinking about, should I be thinking about doing a Roth conversion? There's a lot of people talking about Roth conversions. I talk about Roth conversions a lot here on the channel, but determining what the right amount is for that Roth conversion is going to depend on a number of factors. One of those factors is going to be, how much money do you have in that traditional retirement bucket? And is that going to be a problem for you later as you go into the required minimum distribution stage, when those distributions that are going to be forced upon you at either age 73 or age 75, when those RMDs begin, is that potentially going to push you up into a higher tax bracket, or even potentially push you up into a higher IRMA bracket? So that could even cause your Medicare premiums to go up even pretty significantly here. So the larger your IRA balance is, the more you should be thinking about doing Roth conversions. The other thing that you want to be thinking about, and this is going to be common for, I would say, the vast majority of people, it is at least for our clients, and that is in the early stages of retirement, especially if you retire on the earlier side, maybe you don't have Social Security benefits turned on yet, you don't have a pension, and you really kind of have a really wide open ability to take and distribute the money from your different investment buckets, the tax deferred, traditional retirement accounts, the taxable brokerage accounts, and even the Roth account, and you can distribute those monies in the early part of your retirement and do it at a reduced tax rate. Because at the end of the day, really the decision to do a Roth conversion or to not do a Roth conversion comes down to one simple thing, and that is, what is my tax bracket right now? What do I think my tax bracket is going to be in the future? So you may find yourself, for some people, in a 12% tax bracket in the early part of your retirement, and we've done videos on this. I've done videos where if you need $120,000 a year or $10,000 a month of living expenses, you can do that. Even if you're taking all of those withdrawals from a retirement account, you can do that and stay within the 12% bracket when you factor in your deductions that you get, the standard deduction, and if you're over 65, the new senior bonus deduction and the senior deduction. It becomes a $47,500 tax deduction stack if you qualify for all of those. And then going up into the 22% bracket for a lot of people is something that makes sense, especially if you start to have over $2 million in those IRA balances. And if you have $3 or $4 million or more, then you should really be thinking about targeting a 24% bracket, or even for some people, maybe even going up into that 32% bracket, and that can still save you money. And that's going to be really, we see that happening for people that maybe work longer. We've got a lot of clients that worked well into their 60s and even into their early 70s. They've accumulated even $10, $12 million of retirement assets, and now it becomes a lot trickier to kind of unwind that. So how do you do that in a tax efficient way? So I've made a couple other videos on this. This is part of a series. This is actually the third video where I created some worksheets to help you with three very specific things, and that is to do your calculations for your income taxes in retirement. The first one we did was targeting the 0% long-term capital gain tax bracket, how you can do that, where that income stacks, and how much of your income can you get out of that taxable brokerage account and literally pay zero taxes on that. The second one we did was targeting the IRMA brackets. That's going to be for people, once you turn 63, the IRS starts looking at your modified adjusted gross income, and if it's over a certain threshold, $218,000 for a married couple filing a joint tax return and $109,000 for a single individual, if you're over that amount at age 63, modified adjusted gross income, you're going to start to pay more of a premium for your Medicare benefits. They call it the income-related monthly adjustment amount. It's a Medicare surcharge, and it goes up from there. So the next bracket makes it even more expensive, and then some of those upper brackets can cost literally $400 or $500 more per month for your Medicare benefits. So you want to address this sooner rather than later. In this one right here, we're going to talk specifically about how to target a bracket, and this is going to apply, I think, to a couple of different situations. One is that if you're balances aren't that great inside of your traditional retirement accounts and you want to target a 12% bracket, for example, this is going to make a lot of sense. If you have a lot of money in those retirement accounts and you need to coordinate this with your distributions from a taxable brokerage account, and you're not going to be able to get that 0% long-term capital gain tax bracket because you already have some other income stacked up there and those IRA balances are just too large, this is going to make sense where you can target a bracket here as well. And then it's also going to make sense if you're not yet 63 years old. So if you're 62 or younger, then this IRMA situation really doesn't matter for you because they're not going to start looking at that until age 63. So this is for those individuals. And again, this goes with a series. If you want to download those worksheets, we'll put a link down in the description below. My name is Bill Lethman, by the way. And if you want to check out more about us and find the worksheets, we've got a lot of other resources there that we've created here recently. Moneyevolution.com is our website. So let's hop right in. So just like the last one I did, if you watch that one, I already pre-filled the numbers in here. The first one we did, I did it as we were going through it. I think the video took a little bit longer. This one's probably the shortest out of the bunch in terms of how many pages it is and the least amount of detail. The last one, the IRMA, because there's so many different things that go into that calculation, that was a little bit longer here. So in this example right here, we're going to look at somebody targeting the 22% tax bracket. And now that we have the new tax legislation that passed last summer, the One Big Beautiful Bill Act, we no longer have a sunset on our tax rates. So at least for the foreseeable future, tax rates are going to be with us for a while until a new Congress, new administration gets some new tax laws and maybe those tax rates go up in the future. If they do go up, I'm of the belief that they're probably not going to go up. That's my opinion of that. I think it's very hard to raise taxes across the board. Although, you know, look at the national debt, it is very large right now. I think it's $40 trillion or very close to it if it's not there yet. And so you think they're going to have to do something to get more revenue coming into the federal government. Personally, I'd like to see it come from more of the spending side of things. I think most people hopefully would agree with me on that. But it's very difficult to raise taxes. So if they do raise taxes, it'll probably be at some upper bracket. The last administration, they were talking about doing some tax legislation. They were saying if you're under $400,000 of income, your taxes aren't going to change. And if you're over $400,000, they could be going up. So that's something to think about too. And a couple of things that go into that is how much money you need in retirement. So if you need $300,000 a year for living expenses or $400,000, that's going to probably put you in a certain tax bracket right off the bat because that money's got to come from somewhere. It's either going to come from Social Security, if you're lucky enough to have a pension, or most people it's going to be coming from your retirement accounts, either the traditional or the taxable brokerage accounts, and you're going to be having to take distributions from that. So something to think about. So the 22% bracket, we found that for a lot of our clients is kind of the sweet spot there. It's you know, going up to 24 is only 2 extra percentage points, but then if you go above that, especially later on, that's where that IRMA situation would come in. But 22% for a married couple filing a joint tax return in 2026 allows you to have $211,400 of taxable income, ordinary income, and still be in that 22% bracket. So the way this is going to work here, you're going to fill this in with some of your numbers here. The first thing we want to know is how much money you need to spend in retirement. That's always the number one goal as we're doing retirement planning and retirement tax planning, because again, how much money you need is going to dictate a lot of those taxes there. So we're going to assume that somebody needs $15,000 a month or $180,000 a year. We did the tax, so I've got some tax reference guides that are available as well. We have them up on our website there where you can toggle back and forth between a single and a married filing joint couple there. And basically what you're going to do is you're going to look at where what is the total federal tax at the upper end of that bracket there. And for the 22% bracket, that's just a little bit under $36,000 in total taxes, $35,932. I assume some state income tax. Your state may not have a state income tax. Michigan has a 4.25. That's where we're based out of. So $7,000 is what I just threw a number in there. So the total cash you need is just a little bit under $223,000 of income. And again, you know, you need $180,000, but that's the thing a lot of people miss, and a lot of planners or planning misses too, is because the $180,000 is what you need net, and you're going to need to have some additional income or sources that you're pulling from to get up and cover the taxes on that money that you actually need to live on. So Social Security, a lot of us know that it's taxable up to 85%. So we're going to assume this particular couple here, they're getting $70,000 from Social Security, and the taxable amount of that is $59,500. Incidentally, if you're under 63, you maybe don't turn Social Security on right away, but we put it in here just so you can see how the math works and everything. That's a pretty decent benefit there, and that's probably more like a benefit that somebody would get at their full retirement age. If you have interest income, that's going to also be taxed as ordinary income, so we put in an amount there for $6,000. If you have a pension or annuity income, that's going to typically be ordinary income as well. And if you have a part-time job or income, or maybe you're retired but your spouse is still working, or vice versa, you're going to throw those numbers in here. And then we put in qualified dividends. That's not taxable as ordinary income, but we put it on here because I wanted to capture the gross amount, and I thought that was the best place to put it here. So the total automatic income for this particular couple is $86,000, and the taxable amount of that would be $65,500. Now we're going to look at the funding gap. So if you have $222,932 minus that gross automatic income is $136,932. So that's what we do. That's what we want to be thinking about as we go through these worksheets, is where is that $136,000, almost $137,000 going to come from here? So some of that, and we're a big believer in this, and I mentioned it, this is now in all 3 videos, is having a bucket strategy for taking withdrawals. You're going to have some money that's in bucket 1, cash reserves, money markets, bank savings accounts, maybe some short-term CDs, having those things mature and be available to you to take some of that money out. So you're not having to sell investments that may be down in value there. So we're going to assume that there's $50,000 available to take there, part of our income strategy. A lot of people, I'm not going to get into a lot of detail here, but the Roth, or I'm sorry, the HSA account is a great account for retirement. And the way we like to recommend it to people is that if you have a high deductible plan and you have an HSA available, you can max that out every year. You're going to reduce your taxable income while you're contributing to it. And then rather than using that for your healthcare expenses while you're working, you just save up all of your receipts and you can accumulate them for years or decades. There's no expiration on that. And then in retirement, you can kind of cash in those receipts and take distributions tax-free in retirement. And then you can grow that HSA a little bit more like you would a regular IRA account. You have usually investment options available in those accounts where you can grow that money and then you can distribute it back out in retirement. So we're going to assume that maybe this person is taking $10,000 out from an HSA account. Then we're going to look at preference sources here. Preference income gets stacked up after the ordinary income, and it's taxed on a different tax table than your income tax base, which is all that ordinary income. So when we're targeting that 22% tax bracket, we can go right up to the top of that 22% bracket and then stack investment income or preference income on top of that and be taxed at likely just a 15% tax bracket. Again, that's a strategy and a decision that you need to make kind of year to year and on a long-term basis. So for some people, if they don't have the urgency to get their retirement account balances down, those taxable or those traditional retirement accounts that get those balances down, they might be able to alternate years and do a strategy like we did in that first video where it was a 0% long-term capital gain tax target, and then do Roth conversions in other years. But for a lot of people, stacking these up is probably the appropriate way, especially if you have $2 or $3 million or more in those traditional retirement accounts there. So we're going to assume that they were able to sell some of those investments in that taxable brokerage account and got $100,000 available to them, and the taxable gain on that was $40,000. Yours may be different. We've had clients with $1 million position that has literally a $50,000 cost basis on it. So almost all of that is going to be taxable as a capital gain. But in this case, we just threw a number in there. Your number is going to be different, of course. And that's something you want to look at on a year-to-year basis. What investments you have in that taxable brokerage. Do you have losses that you can harvest to offset some gains? And then that's something that ideally is well suited for refilling some of those short-term cash buckets that you're going to need for your withdrawals and everything. So we have that. And then we went back over here and we added in the taxable preference over there. We already added it into the gross income, so we're not going to do that again. There's a 0 in that spot there. And then we're going to assume here, because I think that with the money that they need and the availability that they have from that stock sale, and the cash savings available to them and the HSA, that they're not going to have to take an IRA withdrawal. All of that really can be left for the Roth conversion amount here. So we're not going to do anything there. You may need to come back to this page if you find out on the next page that there wasn't quite enough money to cover all of the income needs that you have there. So now we're going to put this together. So we're going to come back and reiterate what our tax bracket ceiling is, that $211,400. Our taxable ordinary income was $65,500. We're going to subtract our deductions that we got, and we're going to assume, again, because they're under 63 in this hypothetical example here, they're not going to get the additional deduction and the senior bonus deduction. At this level, if they were 65 years or older, if you're 65 years or older, you probably would get some of that senior bonus deduction, but depending on how much preference income you had and how much Roth conversion, that may go away. But that's something that has to go into that tax comparison calculation, is that if you exceed $150,000 for a married couple or $75,000 for a single individual, you're going to start to get that senior bonus deduction, that $12,000 married or $6,000 single. You're going to get that reduced by a certain amount. And the IRMA bracket calculations actually has a worksheet in there for calculating the senior bonus deduction reduction. So that almost kind of rhymed. Anyway, so the taxable ordinary income after deductions was $33,300. And if we subtract that from the bracket ceiling, it means we have $178,000 available for us to do a Roth conversion. So this is something that a lot of people don't really think about. Again, how that income gets stacked up. And because that preference income and their ability to take money from that taxable brokerage account, get a large amount of money, $100,000, and then the tax on that, $40,000 was the gain. But again, that doesn't interfere or stack up to that $211,000 bracket ceiling there, even though their taxable income would be a lot larger than that. So that gives them a really big opportunity to do Roth conversion. So again, if you think about it, again, depending on how early you retire, how many years you have between retirement and age 73 or age 75 when those required minimum distributions begin, in a 22% bracket in this situation right here, if they could withdraw or convert $178,000 a year at the 22% bracket, does it make sense to go up to 24% even? For a lot of people, the answer to that is no, but that's something that the long-term financial planning that gives us that long-term outlook on what those balances are going to be 10 or 15 years down the road when your RMDs begin. So $178,000 is the Roth conversion. We need to come back and look at the tax on the preference rate income. So we had $50,000 of preference income. We're in that 15% bracket. By the way, that goes up to over $600,000 for a married couple. And I think it's $500,000, I think, still for a single tax filer. That's one of those still areas where there is a little bit of what they call a marriage penalty, because it's not exactly half of what it is for a married couple. But 15% is the tax on that. $7,500 is what that is. And so basically that was not part of the original calculation. So when we did that original calculation and determined that it was, I think, a little bit less than $36,000 in total taxes, that was the tax estimated on the ordinary income. But with that preference income, there's going to be an additional tax on that. That's at $7,500. So if you have additional cash resources or something you can sell without a gain, you could simply do that, and then you can convert all $178,100 to a Roth. Or if you don't have that money available and you had to take it from the IRA account itself, for example, or from the conversion itself, you would reduce that conversion by $7,500 and you would convert $170,600 if you chose option B there. So this was a lot simpler worksheet than some of the other ones, but again, 3 different scenarios, 3 different sets of worksheets, depending on what you're targeting. But remember, you still need to keep in mind, what is the long-term tax strategy? And that's going to be based on a number of factors. Again, how much money you have in those traditional accounts right now. If you're still working, you might be still contributing to those retirement accounts. What is the growth on those retirement accounts between now and retirement? And then as you retire, what is the withdrawal capability or the Roth conversion capability, and how much are you able to reduce that every year and stay within a certain tax bracket? And can you bring that balance down enough by the time you get to that RMD age so that that RMD is not going to be a factor and push you up into a higher tax bracket in the future? So anyway, so if you want to get the worksheets, we have links down in the description below. Again, my name is Bill Lethman for MoneyEvolution.com. Thank you for watching, and I'll look forward to seeing you back in one of our next videos.